You still have to go think, is it a joint venture or a joint operation? All right. But already, if there's no separate legal vehicle or separate entity that is created for this joint arrangement, something like a company or a partnership or something like that, all right, the joint venture is immediately ruled out. Then it can only be a joint operation in the absence of a separate vehicle, all right, through which this joint arrangement is facilitated. All right, let's move on to slide number 11. Joint operator, a party to a joint operation that has control of that joint operation, and then a joint venturer, a party to a joint venture that has joint control of that joint venture. So we're talking about joint operators and joint venturers depending on the type of joint arrangement that we have classified. Then a party to a joint arrangement. Ladies and gentlemen, what's important here? An entity that participates in a joint arrangement, regardless of whether that entity has joint control of the arrangement, that is a party to a joint arrangement. Can you remember my initial example of 5 people or 5 parties? 2 parties are controlling the joint arrangement and they share control contractually. Now, what are the other 3 parties? They don't control. They are also parties to a joint arrangement. Now, these 2 that do control, they are also parties to a joint arrangement. So all 5 of them are parties to a joint arrangement. All right, so that's very important. But the 2 might either be joint operators or they might be joint venturers because they ultimately control together this joint arrangement, making it a joint venture or a joint operation. Happy with that? That's very important that you understand that because a question might be referring to a party to a joint arrangement. And that doesn't mean that that is the joint operator or the joint venturer. That could be one of those 2, but it could also be one of the other 3 parties in our example that do not control the joint arrangement. All right. And then lastly, a separate vehicle. I think this definition is very, very important because you've already seen in the absence of a separate vehicle. Now, here we're not talking about a motor vehicle. Here we're talking about an organization, a form of business that is created, a separate company, a separate entity that is created in which this joint arrangement is basically housed. Now, if we don't have a separate vehicle, a separate entity, we cannot have a joint venture, all right? And that is why it's so important to know what a separate vehicle actually is. Because without a separate vehicle, we rule out the joint venture immediately and it's automatically a joint operator or a joint operation. Now, what is the definition here? A separately identifiable financial structure. You see, so they don't limit it to a company. A separately identifiable financial structure, including separate legal entities or entities recognized by statute, regardless of whether those entities have a legal personality. I want to give you an example. One that has a legal personality is a company, all right, or a CC. We can't create CCs anymore. Do you agree? But that could have been created in the past, just to give you an example. But one that doesn't have a legal personality is a partnership. We know that the partners cannot be separated from the partnership. Do you agree? The partnership doesn't take its own legal responsibility like a company does. And that is why we get legal entities, with a separate legal personality, but we also get entities that don't have a legal separate, a separate personality as such, like a partnership, but it's still a separate vehicle. That's the important part. Okay. So if it's structured through a separate vehicle, it can still be a joint venture or it can be a joint operation. Do you agree? But if there's no separate vehicle, there's no possibility of having a joint venture because then it can only be a joint operation. All right, ladies and gentlemen, in the next chapter, we're going to be looking at the classification of these joint arrangements a bit closer. In chapter 3, let's have a look at the classification of joint arrangements. Now, the characteristics of a joint arrangement, firstly, the parties are bound by a contractual arrangement. We've spoken about that. And the contractual arrangement gives 2 or more of those parties joint control of the arrangement. All right. Remember, joint control unanimous consent. Do you agree? Joint arrangements, once we've classified that joint arrangement, as we've done before, after we've considered IFRS 10, I cannot emphasize that enough. IFRS 10 plays a role in IFRS 11. You cannot establish joint control before you've proven control. And you need to watch the lecture on control, IFRS 10, before you can understand IFRS 11 and the concept of control. Joint arrangements can be joint operations and joint ventures. That's what we've discussed. So this has become very technical, and it's very important that you listen carefully to the principles. Let's move on to slide number 14. Joint control. We've referred what the definition was. We've looked at the definition, the unanimous consent. The first step on slide 14, assess whether the parties control the arrangement collectively. They cannot control it individually. Then IFRS 10 is applicable. IFRS 11 won't be applicable at all. Then you've got a parent-subsidiary relationship. So these two parties control the arrangement collectively. If so, an entity then assesses whether it has joint control of the arrangement. And look at this, only when decisions about the relevant activities, can you see the concept again? Relevant activities. That comes from IFRS 10. So only when decisions about the relevant activities, what are the relevant activities? Those that have a significant impact on the outcome of the entity's returns. All right, significant impact on the returns. Relevant activities must be jointly controlled. So only when the decisions about those relevant activities require unanimous consent of the parties that collectively control the arrangement. Furthermore, what is unanimous consent? I think this definition says it all. Any party with joint control of the arrangement can prevent any other party from making unilateral decisions about the relevant activity without its consent. But then also, you cannot make that decision either. Do you agree? So that's what I said earlier. It's all about prevention and not about forcing your decision through. You cannot make the decisions, but someone else can't make them either, because you need each other's consent in order to make the decision together. And remember that joint control isn't limited to 2 parties. It can be 3 or 4 or 5 parties, but then the control must be there for all 5 together, and then there must be a contract that determines that these 5 cannot make any decisions without the consent of the others. Are you with me? So that's very important for us to establish that unanimous consent. Let's have a look at slide number 15, classifying joint arrangements. A joint operation or a joint venture? That's what we're asking ourselves here. Which one is it? It depends on mainly, and this is what you're going to come across right through IFRS 11. It depends on mainly the rights and obligations of the parties to the arrangement, regardless of the structure and form. All right, so in the past there was a bigger focus on the legal form, was it a separate entity, etc. Now the focus has shifted towards the rights and obligations of the parties. Now, the nice thing about a question that makes this easier is that the information must be given to you in a question, and you can analyze that and make that applicable and earn the marks. In practice, it might be a more difficult story, because there you need to go establish the facts. In a question, the facts are given to you, you don't have any problem. All right, so earn the marks, you can do it, it's easy enough to do. Then, what do we consider in making our decision regarding joint operation or joint venture? Look at the first one, the structure and form of the arrangement. We haven't done away with it. That whole concept of, is it a separate vehicle? We haven't done away with that concept. We're just saying that that isn't the only consideration anymore. That's one of at least 3 here. The second one, the terms agreed by the parties in the contract. So what I'm saying here is that if the parties agree that this party will have a right to 80% of the assets, this party will provide the funding during the operation going on, this party will be responsible for 20% of the liabilities. What does that sound like? That doesn't sound like an investment in an equity share in that company. Do you agree? So that could be a separate vehicle, but it's still a joint operation. All right. So because what primarily indicates to me that this is a joint operation? The fact that they've got rights to the assets and obligations to the liabilities. So the separate vehicle is secondary in that case. All right, so we are still considering the concept of the legal form, the separate vehicle, but then we look at their rights and obligations primarily. And then thirdly, any other facts and circumstances that you feel are relevant in determining, and remember the big picture, in determining whether this is an extension of the joint operator or whether it's really an autonomous separate entity in which we own a percentage of the net equity. All right. When assets or liabilities relating to the arrangement are held in a separate vehicle, this can be a joint operation or a joint venture. But when the joint arrangement is not structured through a separate vehicle, this is a joint operation. Mark that NB because it helps you with the process of elimination if there is no separate vehicle. All right. Slide number 16. Classifying them. What is the effect of a separate vehicle? If the assets and liabilities are held in a separate vehicle, we can still have a joint operation or a joint venture. Do you agree? But if the assets and liabilities are not held in a separate vehicle, that can only be a joint operation. Ladies and gentlemen, why do you think the separate vehicle is so important? Because if you think about it, if there's no separate vehicle, what does the separate vehicle do? It separates the assets and liabilities from the other party. Do you agree? So the question is, not all separate vehicles do that. That's why if there's a separate vehicle, it can still be a joint operation or a joint venture. I'll talk about that just now. But if there's no separate vehicle, that indicates to you that separation from the joint operator is not what is trying to be achieved here. Do you agree? So what's important is that that can only be a joint operation, and we'll go the percentage of assets and percentage of liabilities approach, which is very similar to the proportionate consolidation of IAS 31 before. Now, what's important? Should the assets and liabilities be held in a separate vehicle? If we were to focus on the separate vehicle only, let's say that separate vehicle is a company. What do we know about a company? A company is a separate legal entity with its own legal personality. So what's happened here? There's been real separation of the assets out of the joint venturer's books into the company. So in its simplest form, and ignoring all other indicators, I would say that that would be a joint venture. But let's say this separate vehicle is a partnership. What do you know about a partnership? A partnership is not a separate legal entity. It doesn't have a legal, well, let me rephrase, because it is a legal entity, but it's not a separate legal personality. So between the partners and the partnership, there's no separation, because you know how a partnership works. Think back to your first year and your second year. How do partnerships work? If the partnership goes under and there's any money that is due, the partners have to pay in. That's not the case with a company. Do you agree? And that's why the company has a separate legal personality. So what do you see here? In its simplest form, a company separates the assets and liabilities from the shareholders. Whereas in a partnership, this is a joint operator that basically creates a separate vehicle in the form of a partnership, but the partnership, the nature and characteristics of the partnership are so that they don't separate the assets from the partners. Do you agree? So that separate vehicle might still be a joint operation. So my point here is that a separate vehicle is not the begin-all, end-all of classification. A separate vehicle only determines that it's still possible for there to be a joint venture. All right, because if there's no separate vehicle, there's only a joint operation. All right, you guys comfortable? So this slide number 16, mark that as NB. And remember that a separate vehicle doesn't automatically make it a joint venture. Look at the nature and the characteristics of the separate vehicle. Now, ladies and gentlemen, what did I do now with the partnership versus the company? I looked at the rights and the obligations of